Imagine waking up rich and going to bed broke. Without a war or any warning, a terrifying financial crash stopped the American economic machine mid-stride, shredding the paper wealth of an entire generation. In hours, $200 billion vanished, an amount that, adjusted for inflation, represents the liquid savings and home equity of millions of families erased in a single afternoon. The roaring prosperity of the 1920s ended in a literal overnight ruin. People who spent the summer trading stocks on optimism alone began a decade defined by hunger, breadlines, and the loss of everything they owned. This wasn't a stroke of bad luck. The American economy had been pushed to its mechanical limit, and the structural blowout that followed was the result of a system running far too hot for far too long. The party started in 1922. Factories shifted from military hardware to consumer gadgets for the very first time. Assembly lines churned out toasters, shiny new vacuum cleaners, and modern electric refrigerators for a public eager to spend. Henry Ford's moving assembly line made this scale possible. By 1927, the 15 millionth Model T rolled off the line. Innovation dropped production time from 12 hours to a mere 90 minutes per car, dragging the steel, rubber, and oil industries into a massive growth cycle. Electricity transformed the American home into a shared experience. This family is huddled around a horn-style radio, found in 10 million homes by 1929. For the first time, the entire country heard the same jazz and news in real time. This relentless output created a new psychological reality. Everyday citizens and economists alike believed the country had entered a permanent state of growth, effectively defeating the natural cycles of the market. Hidden beneath the gloss, the economic engine was already knocking. Farmers were drowning in massive debt from over-modernizing their equipment, while urban workers used new installment plans to finance a lifestyle their stagnant wages couldn't actually support. This diagram shows the specific mechanic that turned the stock market into a trap. It's called a margin loan. For every $10 of cash an investor put down, a broker would lend them the other $90 to buy $100 in stock. This leverage let anyone play the role of a tycoon, but the risk was absolute. If a stock's value dropped by 10%, it erased that cash down payment instantly, triggering a margin call requiring immediate repayment. Between 1924 and 1929, the Dow Jones quadrupled. Investors ignored company profits and focused entirely on the rising line of the ticker tape. The American economy had fully detached from the physical world, floating on a delicate bubble of borrowed optimism. The bubble burst on October 29, 1929, Black Tuesday. These crowds gathered outside the stock exchange in stunned silence as prices performed a flawless dive into the concrete, decoupled from any sense of financial gravity. Inside, the physical machinery of the market failed. Ticker tapes fell hours behind the actual trades. $14 billion in wealth vanished in a single session as traders fainted or stared at their empty portfolios in disbelief. These losses hit the real world immediately. The vanished numbers represented lost homes, erased college funds for children, and the shattered life savings of millions of people who never set foot on Wall Street. The crash was more than a financial panic. It was the trigger for a chain reaction. The speculative failure on the trading floor was now moving to destroy the physical economy. As the market tanked, brokers issued thousands of margin calls. Investors who had been rich on Monday were bankrupt by Thursday, leaving the brokers with no way to recover the billions they had lent out. This debt flowed back to the banks. Because these institutions had lent their depositors money to back those stock market gambles, their vaults were suddenly filled with worthless loan contracts instead of cash. Panicked citizens rushed to their local branches, only to find locked doors. This crowd outside the American Union Bank represents the collapse of public trust. Entire families lost every cent they had saved because the bank simply ran out of money. The failure went global. U.S. banks recalled their overseas loans to stay afloat, choking off international trade. Within 3 years, the arteries of global commerce had been cut in half, proving that the entire world was now structurally linked to the American collapse. President Herbert Hoover insisted the economy was sound, even as the country ground to a halt. His administration maintained a policy of denial, encouraging volunteerism, while millions of citizens sat at empty tables. The American engine stalled, Industrial production collapsed by 75%, and unemployment soared to 25%. In Detroit, the massive auto plants that once symbolized the future simply stopped turning. This high-angle shot shows the daily reality for the lucky ones. This winding bread line stretched across a desolate lot, while others moved into cardboard shantytowns. Desperation replaced dignity as the suicide rate surged and marriage rates collapsed. Then the environment failed too. Aggressive over-farming had stripped the Great Plains, and when the wains stopped, the earth literally took flight. These towering dust blizzards buried crops and homes, forcing millions of Okies to pack their cars and flee toward California. The social contract broke in the summer of 1932. The Bonus Army, thousands of World War I veterans, marched on Washington to demand their promised pay. The government responded with tear gas and fire, turning weapons on its own heroes in the shadow of the Capitol. Franklin Delano Roosevelt took office in March 1933, offering the country its first deep breath in years. He promised immediate, state-sponsored action to fix the machine, rather than just waiting for it to restart itself. Through the CCC and WPA, the government mobilized millions to plant billions of trees, build massive dams, and lay the foundations for the modern American power grid. They were rebuilding the country's physical infrastructure and the dignity of its workforce simultaneously. To prevent another blowout, Roosevelt installed the first real safety valves. The SEC was created to police Wall Street, and the FDIC was established to ensure bank deposits, ensuring that a market crash could never again erase a family's entire life savings. Dorothea Lange's Migrant Mother captures the weary resilience of the era. It is a portrait of a generation that survived not through optimism, but through the sheer endurance required to reach the next day. By the late 1930s, the American machine was humming again, but the gears were shifting. Assembly lines were moving away from consumer gadgets and toward the production of boots, helmets, and ammunition for a global war that was already visible on the horizon.